Hi, this is Kevin Bergeau, Philly Mortgage Team, where we try and get you the best, clearest information on everything to do with mortgages and real estate so that you can make terrific decisions and get clear to close as easy as possible. So what are we talking about today? Today our topic is going to be acronyms. Yes, acronyms. So we use so many acronyms in the real estate and the mortgage industry that it drives you crazy and it's hard to figure out what the heck we're talking about. So I'm talking about LE, CD, LTV, Alta, FHA, VA, PHFA, PITI, because I pity the fool that doesn't know their acronyms in the mortgage businesses so they can get clear. PDQ, little Mr. T. Okay, so we're going to break them down for you, and we're going to do it one at a time. So today we're going to speak about debt to income. Debt to income ratio. It's one of the most important acronyms and one of the most important ratios that you'll need in the mortgage industry to get clear to close. So without further ado, let's go to the chart. You like this little chart I made up. So anyhow, so what we're talking about is your debt to your income. How much debt you have per your gross monthly income. Gross monthly income is prior to taxes. So on your gross monthly income, if you look, we used an average of $5,400 a month for most Americans. Hard to read upside down, but okay. $5,400 a month. And then we look at your bills. So what kind of bills are we speaking about? We're speaking about the bills that appear on your credit report, which you may not know what they are. So let's identify them kind of quickly, like a car payment, anything that you have a loan for, student loan, credit card debt. That are the type of debt that will appear on your credit report. What will not appear is your monthly living expenses, food, clothing, shelter, because your rent will not count because you won't be renting anymore. So those type of things, electric bills, they don't normally appear. Water bills don't appear on your credit report. So it's just these three that we're going to use the example for today. So let's start with car payment. Car payment of $325, student loan of $350, and monthly credit card debts. And we're looking at your minimum monthly debt. So your minimum monthly debt may be $100 a month. You may pay $150 to get it paid off, but we're just looking at the minimum monthly debt. So if you add these three things up, they come to $775 a month. Now, let's look at your income, which is $5,400. So what else do we have to do here? We have to look at what your mortgage payment is going to be. We used a purchase price of $350,000. We only used 5% down. We want to be conservative and look at the worst case scenario. So with 5% down, you're looking at a loan amount of $332,500. So we'll start out with your principal and interest, PI, another acronym. Principal and interest, $1,402. Taxes, $350. Pay close attention to your taxes when you're looking for a house. You can find a $350,000 house with taxes of $2,000 a month. You can find a $350,000 house with taxes of $6,000 a month. Depends where you're looking and what their tax rate is. So pay close attention to that. And then we have your homeowner's insurance, generally around $100, a little bit less, a little bit more, depending upon the house and other factors. And PMI, another acronym. Private mortgage insurance. If you're putting less than 20% down, you will usually need PMI. So we used $67 for that. So that makes your total payment of $19.19 a month. So we take the $19.19 a month, add it to your monthly bills of $775. That gives us a total of $26.94. That's your monthly debt. That's what it's going to be. Divide that by your monthly income, your gross monthly income, $5,400. And you will get a debt to income ratio of 49.98%. So what does that mean? Different programs use different debt to income ratio limitations. For conventional loans, you can usually go up to 50%, depending upon your credit score and other factors. FHA, you're allowed to go a little bit higher. You can go to 57%. On jumbo, which are loans over the conventional or conforming loan amount, which in this area is $548,250, for jumbos, it's usually around 43% for your top debt to income ratio. For a VA, it's, yes sir, what do you need? So pay attention to the programs. It depends what program you're using. That'll give you your debt to income limit. And that's your total debt to income limit. Some programs do look at just your front end ratio, which is just your mortgage payment, which we put here in little. So put your mortgage payment and divide that by your monthly income, which in this case, this person has a 35.5% debt to income ratio. So that's it. If you have any questions, please feel free to reach out to us, Philly Mortgage Team at afncorp.com, or give me a call, 215-681-3587. Thank you so much.